Nothing happened today. No emergency announcement, no press conference, no flashing headline on CNBC or Bloomberg. And yet, something extremely important just changed in the silver market. Quietly, deliberately, and without asking for your attention. China just locked physical silver for the next 30 days. Not on paper, not in futures. Physical metal. The kind that has to be mined, refined, shipped, and delivered. And they didn't announce it because they didn't need to. This wasn't a reaction meant to calm markets or send a signal to speculators. This was a logistical decision buried deep in policy language and export flow data. The kind of move that only shows up when someone is preparing, not reacting. And here's why you should care. When China restricts physical flow, even temporarily, it's never about price. It's about availability. It's about making sure that when stress shows up elsewhere, their supply is already secured. 30 days may not sound like much, but in a market this tight, 30 days is an eternity. The most dangerous shifts in markets don't come with sirens. They come quietly while everyone is distracted by charts and headlines. This isn't a bullish headline. It's a warning signal. Because when the largest physical player in the world stops letting silver move freely, the real story is no longer about price. It's about control. To understand why this quiet 30-day lock matters, you first have to strip away the way most people think about silver. Because what China just restricted is not a trade, not a position, and not a market bet. What they touched is flow, and in commodities, flow is power. When we say China locked physical silver, we are not talking about futures contracts or paper exposure. We are talking about metal that already exists, that already sits in warehouses, that is already allocated to industrial pipelines. This is silver that would normally move across borders, into refiners, into manufacturers, into global supply chains. A 30-day lock doesn't mean silver disappears, it means silver stops circulating. That distinction is critical. Most global silver availability doesn't come from fresh mine supply. It comes from existing inventories being recycled through the system. Metal moves from vaults to factories, from factories to products, from scrap back to refiners. When China pauses outward flow, even temporarily, it removes a major artery from that circulation system. And China isn't just another participant. It is one of the largest processors, consumers, and strategic holders of physical silver on the planet. When China acts on physical metal, the impact is nonlinear. A small administrative change can produce outsized global effects because so much downstream activity depends on Chinese throughput. This is why the phrase 30 days is misleading. In supply chains, time is not linear. Delays compound. A 1-month pause doesn't simply push deliveries back by a month. It forces rescheduling, substitution, stockpiling, and hoarding behavior. Participants upstream and downstream adjust defensively, often at the same time. That's how stress propagates. Now let's address the silence, because silence is part of the signal. If this were routine maintenance, it would be communicated casually. If it were administrative cleanup, it would be announced. The fact that this move showed up quietly, through flow constraints and policy adjustments, tells you it wasn't meant to influence sentiment. It was meant to change reality. China doesn't manage commodities the way Western markets do. It doesn't rely on price to do the work. It relies on control. When Beijing wants stability, it doesn't talk, it allocates. When it wants insulation, it doesn't speculate, it restricts. A 30-day lock functions like a buffer being raised. It ensures that internal demand is met first, regardless of what happens elsewhere. It prevents sudden external pulls on inventory at exactly the moment global conditions are becoming less predictable. And that brings us to another critical point. This kind of lock is not about shortage today. It's about avoiding shortage tomorrow. China historically acts before stress becomes visible. It does not wait for inventory levels to collapse or for prices to spike violently. By the time stress shows up on charts, China has usually already adjusted policy. That, or yes, why these moves feel out of nowhere. To Western observers, they are not reactive, they're anticipatory. The 30-day window matters because it lines up with something else: uncertainty. Markets globally are navigating liquidity events, volatility spikes, and structural stress. When uncertainty rises, physical commodities behave differently than financial assets. They become insurance. By locking physical silver, China is removing optionality from the global system. It is saying, quietly, this metal is not available for external relief right now. That has consequences, even if price doesn't react immediately, because price is the last thing to move. Paper markets can absorb stress temporarily. They can stretch supply through leverage, leasing, and derivatives. But physical markets are binary. Metal is either available or it isn't. And when a major holder pauses distribution, pressure builds invisibly. This is why 30 days is more than enough to matter. It overlaps with contract roll periods. It overlaps with industrial restocking cycles. It overlaps with delivery schedules that assume normal flow. When those assumptions break, participants don't wait. They secure supply early. That behavior tightens markets further. Another misconception is that this only affects exports. It doesn't. Even internal locks change behavior externally. When internal allocation is prioritized, less surplus exists. Less surplus means less flexibility. Less flexibility means higher sensitivity to shocks. And shocks don't have to be silver specific. They can come from energy markets, currency moves, logistics disruptions, or financial stress. When they do, the ability to respond quickly depends on whether metal can move freely. Right now, one of the biggest players has chosen not to allow that. This is why you shouldn't think of this as a pause. It's a posture, a defensive stance that assumes volatility elsewhere could spill into physical demand. And notice what China didn't do. It didn't buy aggressively in public. It didn't drive price higher. It didn't announce accumulation. Those are noisy moves. This was quiet. Quiet moves tell you more. They tell you that someone is less concerned with optics and more concerned with outcomes. They tell you that the priority is control, not signaling. And they tell you that the system is being positioned for a scenario that has not yet fully arrived. The most important takeaway from this section is simple. Locking physical silver for 30 days is not a minor policy tweak. It's a flow intervention, and flow interventions change markets long before charts do. Price may stay calm, headlines may stay silent. But availability is being altered right now, and availability, not sentiment, is what ultimately determines how violent future adjustments can become. This is why the move matters, not because it's dramatic, but because it's deliberate. To understand why this happened now, you have to stop looking at silver in isolation and start looking at stress across the entire system. China didn't wake up one morning and decide to micromanage silver flow for no reason. This kind of decision is only made when multiple pressure points begin to align, even if none of them look critical on their own. The first pressure point is global liquidity. Over the past several months, liquidity conditions have become increasingly uneven. Capital is available, but it's cautious. Credit still exists, but it's selective. When liquidity becomes fragmented like this, physical commodities start behaving differently than financial assets. They stop being traded instruments and start becoming strategic reserves. China understands this distinction better than anyone. When financial systems show signs of strain, China historically shifts focus from market efficiency to material security. That doesn't mean panic, it means preparation. And preparation always happens quietly before stress becomes visible. Silver sits at a unique intersection of this process. It's not just a monetary metal and not just an industrial input. It's both. That dual role makes it especially sensitive to instability. When uncertainty rises, demand doesn't have to spike dramatically to create problems. Even a modest increase in precautionary behavior can overwhelm available supply. China doesn't wait for that to happen. Another factor is industrial visibility. China has unparalleled insight into real demand. Not forecasts, not surveys, but actual factory orders, inventory levels, and forward production schedules. When those internal signals begin to tighten, policy adjusts upstream. A 30-day lock suggests that something in those internal pipelines required stabilization. Not emergency-level shortage, but enough imbalance to justify intervention. This could be rising industrial demand, thinning buffer stocks, or concern about external pull draining reserves faster than expected. What matters is that China saw a future constraint, not a present crisis. Timing also intersects with global silver market fragility. Physical inventories outside China are already thin relative to paper claims. This imbalance doesn't cause immediate failure. It causes sensitivity. The system works as long as flows remain predictable. The moment predictability drops, stress accelerates. By locking physical silver now, China removes itself as a shock absorber. It ensures that if demand spikes elsewhere, that pressure doesn't immediately translate into outflows from its own system. This is classic defensive policy. There's also a geopolitical layer that can't be ignored. Strategic metals are increasingly viewed through the lens of national resilience. Supply chains are no longer assumed to be neutral. They are leverage. In that environment, allowing unrestricted movement of critical materials during uncertain periods becomes a vulnerability. China has spent years reducing dependence on external supply. Now it is applying the same logic in reverse, limiting external dependence on its material flows. And silver, despite being less discussed than rare earths or energy, plays a crucial role in technologies that China prioritizes. Solar, electronics, advanced manufacturing, all are silver intensive. Securing uninterrupted access is non-negotiable. A temporary lock is an elegant solution. It avoids market disruption while ensuring internal stability. It also buys time to observe, reassess, and adjust further if needed. This is another reason why the 30-day duration matters. It's long enough to cover near-term uncertainty, but short enough to remain flexible. China is not committing to a permanent restriction. It is testing conditions. The testing mindset is key. China often uses short, quiet policy shifts as probes. It watches how markets react, not in price, but in behavior. Do inventories elsewhere tighten? Do premiums rise? Do delivery delays appear? These signals inform the next move. If conditions normalize, the lock can be lifted quietly. If stress increases, restrictions can be extended or intensified. This optionality is valuable, and it only exists when moves are made early. There's also a domestic monetary angle. Precious metals play a role in financial confidence, even when not explicitly acknowledged. In periods of currency uncertainty or capital flow sensitivity, maintaining strong internal commodity buffers helps stabilize expectations. This doesn't mean China expects a currency crisis tomorrow. It means it is reducing exposure to tail risks. That's what prudent systems do. And notice again what China didn't do. It didn't raise alarms. It didn't communicate urgency. That tells you the move is calculated, not reactive. Urgent actions are loud. Calculated ones are quiet. Another overlooked aspect is how this timing intersects with Western market assumptions. Much of the global silver trade assumes Chinese availability as a given. When that assumption changes, even temporarily, it forces rethinking elsewhere. Refiners adjust sourcing. Manufacturers increase buffer inventory. Traders reassess delivery risk. All of this tightens the system further, even without any new demand. This is how small policy shifts create large effects. China understands these dynamics intimately. It doesn't need to dominate price to influence outcomes. It only needs to adjust flow at the right moment. So why now? Because the system is more interconnected, more leveraged, and more fragile than it appears. Because physical inventories are thin. Because uncertainty is rising across multiple domains. And because silver sits at the crossroads of industry, finance, and strategy. This move wasn't about silver's price today. It was about ensuring silver's availability tomorrow. And that tells you everything you need to know about why it happened now, before anyone was looking. Once China restricts physical silver flow, even temporarily, the effects don't stay local. They radiate outward through a system that is far more dependent on uninterrupted movement than most people realize. And this is where the real consequences begin. Not immediately in price, but in behavior. The global silver market functions on the assumption that metal can always be sourced somewhere. If one region tightens, another compensates. If demand rises, inventories move. That assumption only holds when major players remain flexible. China stepping out of that role, even for 30 days, removes a key stabilizer. The first impact is on availability, not supply. Mines don't shut down. Production doesn't suddenly fall. But usable metal, deliverable metal, becomes harder to access. This distinction matters because industrial users don't care where silver comes from. They care whether it arrives on time. And when China pauses outward flow, alternative sources are forced to absorb more demand. That pressure concentrates stress in fewer places. Inventories that once felt sufficient suddenly look thin. Delivery schedules tighten. Premiums rise quietly, often off exchange. This is how physical stress shows up, not with headlines, but with delays and adjustments. Next comes behavior change among intermediaries. Traders, refiners, and distributors start acting defensively. They increase buffer stock. They delay sales. They prioritize long-term clients. Each of these decisions makes sense individually. Collectively, they reduce circulation. Reduced circulation makes the market brittle. Paper markets can mask this for a while. Futures contracts can be rolled. Leases can be extended. Promises can be made. But physical obligations eventually surface. When they do, the gap between paper availability and physical availability becomes visible and uncomfortable. China's lock accelerates this process by tightening the physical side, while paper remains unconstrained. That divergence increases systemic risk. The longer it persists, the harder it becomes to reconcile without price volatility. Another key consequence is price sensitivity. When flow is restricted, price responds more violently to incremental changes. A demand increase that would normally be absorbed smoothly now causes sharper moves. A logistics disruption that would have been manageable now creates outsized effects. This doesn't mean price must immediately surge. It means the distribution of outcomes widens. Calm becomes fragile. There's also a psychological shift. Market participants begin to question assumptions. If China can quietly restrict silver once, it can do it again. That uncertainty alone changes behavior. Participants start planning for tighter conditions, even if conditions haven't visibly tightened yet. That anticipation tightens markets preemptively. Another downstream effect is on leasing and borrowing. Physical silver is often lent into the market to meet short-term needs. When holders become more cautious, lease rates rise. Borrowing becomes more expensive. This pressure feeds directly into derivative markets where cost assumptions are based on cheap availability. Rising lease costs don't just affect traders, they affect pricing models. And when models change, positioning changes. We've seen this pattern before in other commodities. Quiet flow restrictions lead to sudden repricing later, not because supply vanished, but because flexibility did. Silver is particularly vulnerable to this because inventories are small relative to total usage. China's role amplifies this vulnerability. As both a major consumer and a processor, its decisions affect multiple stages of the chain. A pause at one point ripples through many. Another consequence is geopolitical signaling, even if unintended. Other countries notice. Strategic planners notice. When China secures material quietly, others reassess their own exposure. That can trigger parallel behavior elsewhere: stockpiling, diversification, and restriction. This is how localized actions become global trends. Importantly, none of this requires panic. It only requires prudence. And prudence, when practiced by many at once, tightens markets faster than speculation ever could. The global silver market is now operating under a new constraint, one that didn't exist before the lock. Even if it's temporary, its effects linger. Trust in uninterrupted flow has been dented. And once trust weakens, systems become less efficient and more volatile. This is why the impact of China's move cannot be measured in days or price ticks. It reshapes behavior across the supply chain. It increases sensitivity. It reduces tolerance for shocks. The lock doesn't need to last forever to matter. It only needs to remind participants that physical silver is not guaranteed, and that reminder alone changes the game. This is why China's 30-day lock on physical silver should not be viewed as bullish news, bearish news, or even market news in the traditional sense. It's signal news, and signals matter far more than headlines because they reveal intent. China did not restrict silver to move price. It did not do it to send a message to traders. It did it to reduce uncertainty for itself. And in doing so, it quietly increased uncertainty for everyone else. That asymmetry is the red flag. When a system feels stable, large players don't interfere with flow. They let markets do the work. Interventions happen when stability is assumed to be fragile. The fact that this was done silently tells you confidence wasn't high enough to rely on price alone. This is not accumulation behavior. Accumulation is loud, visible, and often price-driven. This was containment. Containment is what you do when you want to make sure something doesn't leave your control during a period of potential stress. And containment always precedes visible disruption, never follows it. The most important takeaway is that China is behaving as if physical silver may become harder to source in the near future. Not impossible, not catastrophic, just constrained enough that allowing free outward flow would be a mistake. That mindset matters more than the duration of the lock. Markets tend to underestimate quiet policy shifts because they don't fit into traditional narratives. There's no chart pattern, no economic release, no analyst upgrade. But history shows that these are often the moves that matter most, because they are rooted in logistics, not sentiment. Once logistics change, price eventually has to follow, even if it lags. This doesn't mean silver must spike tomorrow. It means the margin for error has narrowed. It means the system has less flexibility than it did before. It means future shocks, even small ones, can have disproportionate effects. And perhaps, most importantly, it means someone with the best visibility into real-world demand decided that waiting was riskier than acting quietly. That's the red flag. The mistake most people make is looking for drama. Real stress rarely announces itself. It shows up in behavior, in small, quiet decisions that alter flow, secure supply, and reduce exposure before anyone is paying attention. China just made one of those decisions. And once you understand that, the story stops being about 30 days. It becomes about why those 30 days mattered enough to act at all. Because in markets, the most important changes happen before you're told to look.